Many founders are losing out on millions in funding because of simple financial modeling mistakes. And I see this happen way too often. I personally reviewed over thousands of financial models, and I've helped companies like HyperTrader secure $1.55 million in funding by fixing some of these common mistakes. In this video, I'm going to be breaking down the 3 biggest financial modeling mistakes that could cost you millions. These are mistakes that make investors walk away, but the good news is that you can fix them. Let's first talk about why this matters. When you pitch your startup to investors, your financial model is one of the most important tools that you have. It's not just a spreadsheet, it's your business's story and numbers. It tells investors how you're generating revenue, how fast you're going to grow, whether you actually understand your own numbers, and way more. A lot of founders see a financial model as just an Excel sheet filled with formulas only useful for fundraising, and then it's never looked at again. But in reality, it's your business's financial roadmap. Get it right and you'll build investor confidence, and you'll be able to make informed strategic business decisions. Get it wrong and you raise red flags that can cost you funding, or worse, land your startup in the startup graveyard. The first mistake is the hockey stick revenue curve. One of the biggest mistakes founders make in their financial models is projecting a hockey stick revenue curve, predicting massive, unrealistic growth without a clear plan to back it up. I get it, you believe in your company's potential and you want to show investors exciting numbers. But if your projections don't have a solid foundation, investors won't take them seriously. I've seen plenty of founders predict 3x revenue growth every month, but when I ask how they plan to get there, their answers are vague. They haven't mapped out customer acquisition strategies, or accounted for sales cycles, or considered churn or retention. Without those details, investors are left with more questions than confidence in the numbers. They want to see a clear, realistic growth strategy that's backed by data. Let me give you an example. A founder I worked with projected their revenue jumping from $100K to $10 million in just 6 months. It's ambitious, but maybe a little far-fetched. And when I asked how they'd achieve that, they struggled to explain. They hadn't factored in customer acquisition costs or lifetime value, overhead, net MRR growth rate, and other key metrics. In short, their model showed an unrealistic best-case scenario, and there was no strategy behind it. If your financial projections don't have a solid foundation, investors are going to see right through them. They want to know how you'll reach those numbers step by step. If your growth predictions seem unrealistic, they'll assume you don't fully understand your business, and that's a huge red flag. So, how do you avoid this mistake? The key is to base your projections on real data, not just optimistic assumptions. Start by analyzing historical trends. If you don't have past revenue data, look at industry benchmarks and competitor performance to set realistic growth expectations. Next, break your revenue down into clear, measurable components. Where will your customers come from? What marketing channels are going to drive marketing qualified leads and new customers? What are your expected conversion rates? Instead of throwing out big numbers, show step by step how you're going to reach them. Keeping your financial model simple is also key. Avoid cluttering it with unnecessary details that don't add any value. Instead, focus on the core metrics that actually drive your business. Break the model into smaller, manageable sections that can make it easier to understand. And visuals are also going to help a lot. Use charts and graphs to make your data clear and digestible. Highlight the most important metrics and trends so that they can quickly see the growth potential. Now, luckily, Forecaster has a dashboard builder so that you can see all of your most important metrics at a glance. Another key to making your financial model effective is keeping it updated. Outdated data leads to inaccurate forecasts and poor decisions. Market conditions change fast, and even small adjustments in your business can impact your performance. That's why updating your financial model regularly is a good idea, at least once a quarter, but we recommend once a month. If you use an accounting system, integrations and real-time data can make this process completely seamless. Otherwise, set a dedicated time to review and refresh your numbers. Keeping your model updated ensures your projections stay accurate and useful. Lastly, document your data sources and update them when needed. This way you can easily track which numbers are fresh and which may be outdated. A well-maintained, data-driven financial model will impress investors and help you make better business decisions. Finally, using a well-structured financial template can make a huge difference. Now, Forecaster offers free templates designed for different business models, making it really easy to get started. Now, before we move on to the next mistake, if this is at all useful, make sure to hit the subscribe button. We post videos like this every week to help you build better financial models, raise more capital, and scale your startup. I'd love for you to join me. This brings us to the second mistake, which is missing customer economics. Understanding your customer economics, or unit economics, is the foundation of a strong business model. Yet many founders make the mistake of ignoring or miscalculating these financial metrics, especially whenever it comes to customer acquisition and retention. If you don't understand your numbers clearly, investors begin to lose confidence. One of the biggest issues I see is businesses failing to properly calculate their customer acquisition costs. Many founders oversimplify CAC CAC by dividing marketing spend by the number of new customers, but fail to account for the full cost of acquiring those customers. This can include sales team salaries, commissions, software costs, onboarding expenses, and discounts for first-time buyers. And if these costs aren't factored in, the CAC calculation can give an incomplete and overly optimistic picture, making it harder to scale profitably. Another common oversight is incomplete lifetime value calculations. Many founders calculate lifetime value by simply multiplying the average revenue per user, or ARPU, by the number of years they expect a customer to stay. But this oversimplifies the reality of customer retention. A proper LTV calculation should factor in churn rates, gross margins, and retention costs like customer support and loyalty programs. If you ignore these factors and only focus on revenue, your lifetime value estimate will be inflated, which leads to optimistic assumptions about profitability and growth. Investors want to see an LTV that reflects not just revenue potential, but the actual contribution margin after accounting for the cost of servicing and retaining customers. And let's talk about churn. It'd be awesome if when a customer signs up, they stuck around forever, but that's not always the case. Every business has some level of customer turnover, and for a subscription-based company, even a small increase in churn can significantly impact growth and profitability. If you're not tracking and managing your churn, your financial model is missing a critical component. Investors will always ask, how many customers churn every month? What's your plan to reduce that number? And if you can't answer these questions with clear data and retention strategies, they'll see your business as high risk. A strong financial model doesn't just project new customer acquisition, it accounts for retention, ensuring sustainable long-term growth. Let's break down your unit economics. So, how to get your CAC right. Start by calculating all costs related to acquiring a customer. This includes ad spend, sales team salaries, software fees, and even onboarding costs. Be as detailed as possible. Then, track how these costs change over time. As your business grows, CAC may fluctuate depending on new channels, customer segments, or market conditions. If your CAC is rising without proportional increases in customer value, you want to investigate why and adjust your acquisition strategy. Make sure your lifetime value is accurate. Your lifetime value calculation should go beyond just revenue. It's got to factor in customer retention costs, churn rate, upsell potential, and expansion revenue from cross-sells or referrals. If you don't have any historical data yet, use industry benchmarks, but refine your model as you collect more data on your business. A strong LTV gives investors confidence that your customers generate long-term value that exceeds the acquisition costs. Monitor and manage churn. So churn is inevitable, but it can be reduced with the right strategies. Track how many customers leave and why. Are they struggling to see value in your product? Is customer onboarding too complicated? Are they switching to competitors, or are you losing them due to poor engagement? Identifying your churn patterns allow you to refine your product, improve retention strategies, and increase long-term profitability. Track your CAC payback period. Finally, tie everything together by tracking your CAC payback period, which is the time it takes to recover the cost of acquiring a customer. Investors want to see that your revenue model supports sustainable growth. And if your CAC payback period is too long, it can strain cash flow and require more capital to sustain operations. To improve it, you can optimize pricing, reduce customer acquisition costs, or enhance retention. A healthy CAC payback period ensures your business can scale efficiently without running into cash constraints. Mastering these numbers gives you a competitive advantage. Businesses that truly understand their unit economics are ones that succeed. Data-driven approach strengthens your company and makes it more resilient and more profitable. And if you want a rock-solid financial model that impresses investors and helps you make smarter decisions every day, consider using a dedicated financial modeling solution like Forecaster. Our expert financial analysts will work with you to ensure that your model is accurate, reliable, and ready for fundraising. Today's video is brought to you by Forecaster. Now, I created Forecaster after seeing entrepreneurs struggle with their financials. Many would refresh their bank accounts every day, they'd stress over cash flow, and they'd try to cobble together these clunky spreadsheets to try to understand their business. And when it came to fundraising, things got even harder, leading to confusing financial plans that really hurt their credibility with investors. That's why we built Forecaster. It's world-class software designed to make your numbers clear, attract investment, and to help you grow faster with the power of data. Plus, every customer is paired with an expert financial coach to guide them every step of the way. Click the link below for a free 30-minute discovery session with our team. If you're a fit to move forward, we'll throw in a free 10 hours of analyst time, which covers the full cost of your onboarding into our software. Now, we only take 50 new customers per month, so claim your spot today. Spots are very limited. The third mistake I see is the perfect world scenario. Many founders build financial models assuming everything will go exactly as planned. Customers are going to sign up effortlessly, revenue grows without setbacks, and competition doesn't exist. But real businesses face real challenges, and investors know that. I once worked with a startup that had a fantastic product, a really strong team, and on paper their financial model was flawless. Steady customer demand, rapid growth, and no major hurdles. But when I asked them what would happen if their revenue fell short report by 20%, they had no answer. They hadn't planned for setbacks, and that's a big red flag for investors. Investors don't just want to see the best case scenario. They want to see preparedness too. If customer acquisition costs rise, will you still be profitable? If market conditions shift, can your business survive? Ignoring these risks can make your model unrealistic, and investors will take notice. A strong financial model shows potential success and proves that you can handle uncertainty. That's where sensitivity analysis comes in. Sensitivity analysis tests different assumptions in your model to see how changes in business variables impact your business. For example, what if your marketing costs double? What if conversion rates drop by 30%? What if customer retention rates decrease? By running these scenarios, you can identify the most critical factors affecting your business and prepare accordingly. Investors want to see these insights because they prove that you're thinking ahead and managing risk proactively. So, how do you fix it and build a stronger financial model? The first step is to document your assumptions. Your financial model is only as strong as the assumptions behind it. Factors like pricing, customer acquisition costs, market trends, and operational expenses shape your projections. Clearly outline these assumptions in your model and review them regularly to ensure that they remain accurate and relevant. Outdated assumptions lead to misleading forecasts, which weakens investor confidence. The second key step is to test different variables. Business conditions are constantly changing, and if your financial model only accounts for a single outcome, you're exposing yourself to unnecessary risk. Use sensitivity analysis to identify which factors, like pricing or customer churn or customer acquisition costs, have the biggest impact on your financial performance. Then adjust your model accordingly to ensure that it remains realistic and adaptable. The third key step is to analyze your competition. No business operates in a vacuum. Your competitors are constantly evolving, and your financial strategy needs to as well. Do a competitive analysis to identify gaps in the market where you could gain a competitive advantage and assess potential threats that could impact your growth. The fourth key step is to prepare contingency plans. What happens if your sales slow down? How will you maintain profitability if costs rise unexpectedly? Having a backup strategy isn't just about risk management, it's about confidence. When challenges arise, you don't want to be scrambling for solutions under pressure. A strong contingency plan ensures that you can pivot quickly and keep your business on track. Investors value founders who anticipate risk and have a clear strategy to navigate uncertainty. Showing that you've considered worst-case scenarios and have a plan to mitigate them demonstrates that you think long-term, which builds trust and credibility. These are the 3 financial modeling mistakes that could cost you millions. Fix them and you'll have a financial model that not only stands up to investor scrutiny, but sets you up for real success. Now, if you want to learn how to get your startup funded, click this link here. I'll see you over there.